Hey, good morning, options traders. What's happening, everybody? Well, I got a good question from one of the traders in our group, in this case, asking about a vertical spread. But their question centered on what's the difference of, let's say, buying one spread that has a maximum gain of 2 and another spread that has a maximum gain of 8. What if I buy the first spread 4 times? Does that make them exactly equal? Well, it's a really good question, because it really gets down to risk and reward. And there are some hidden things that you have to understand that are going on when you start scaling out strategies. It's not just for vertical spreads, because we could do this with any strategy. You could always multiply it out and scale it out so that it equals the expected gain from another. And it doesn't necessarily make them equal. And the reason is the slippery delta slope. So let's take a look at an example. So let's start with a question. Let's say that on one hand, the stock is trading at 400, and we're looking at the 400-420 vertical spread. And we throw it into a pricing model, and it says that it's worth 12 bucks. So notice that because the difference in strikes is 20, that's the most the spread could ever be worth, is 20 points. And because we paid 12, the maximum gain to us, or the max profit, is therefore 8. Well, hold that thought for a moment. Let's go take a look at another stock, let's say trading at 100 bucks. And we're looking at the 100-105 vertical. So in that same pricing model, assuming all else being equal, it tells us that this vertical spread is worth 3. And because there's a 5-point difference in strikes, that's the most the spread could ever be worth. If we paid 3, the maximum gain to us is 2. So take a look here. The first spread is worth 12. But the second spread is worth 3, 1/4 the cost. And that's because I knocked the stock price from 400 to 100, 1/4 of the price. And look what it did for the maximum gain. Took it from 8 down to 2. Again, 1/4 of the maximum gain. So this trader's question was this: what if we bought one 400-420 vertical spread for 12, but instead I bought 4 of the 100-105s? And that would also cost me 12. Remember, one spread is worth 3, so if we buy it 4 times, it's therefore worth 12. So in both cases, our maximum gain would be 8. And so this trader was saying, well, does that make them exactly equal? Well, again, you have to be very careful here. In some ways, yes, we can always scale it out, in this case multiplying it by 4, to make the maximum gains equal. But there's really more to the story there. So let's take a look at these individually. First, the 400-420 vertical spread. Here's our 400 strike. Here's our 420 strike. There's our bends. Maximum loss is 12. Max gain is 8. Let's take a look at the 100-105. We get a bend at 100, another at 105. Our maximum loss is 3, and the maximum gain is 2. So again, what they were saying is that if I bought this spread 4 times, we just multiply these numbers by 4. And that means my maximum loss is now 12 and the max gain is 8. Exactly the same as the 400-420. So again, does that really make them equal? Well, one of the things that makes this hard to compare is that we're looking at different stock prices. See, if I tried to put the 400-420 vertical spread on this scale, it would be way out here to the right. 400's way out here. We're down at 100. So how can we compare them and let them overlap each other? Well, one way to do it is to put them in percentage terms. So let's do that, and let's look at a percentage scale. So 0 right here means we're looking at the money. So the spread in red is the 100-105. So because in this case the stock is at 100, it's not up or down. 0% gain and 0% loss from that current stock price. For the 400-420 spread in green, this would represent 400, because remember, that was the current stock price. So if the stock is 400, it's got no gain and no loss, and again 0% change. So look at the 100-105 spread again in red. If the stock is up 5%, that means it's gone from 100 to 105. It puts us at maximum gain with the stock at 105. But take a look at the one in green, the 400-420. If the stock price rises 5%, it gives us an $8 maximum gain for the same 5% move. But it's also a $20 move. And ultimately what matters are the dollars. And so really what's happening here is the market is saying, yes, it's a 5% move in both cases, but because there's 4 times the amount of money that could be made on the 400, 420, we're going to make the cost of that, or the value of it, 4 times as much. So you have to see that even though they appear to be equal, the 400, 420 is actually riskier. Because you see the slope of this green line, how steep it is compared to this on the red? I'm just looking between the strikes. So I've often talked about thinking of this as a side of a mountain, let's say a ski slope, right? If you're up here on the top and about to ski, that's a really steep drop. In other words, there's a lot of risk. The price changes in that position are going to be a lot more rapid than they will here in red. See, if you were standing here skiing and skiing down this slope, it's not as steep. And that's to say that it's not as risky. And it's another way of understanding why there's 4 times the amount of gain here. You could say that there's 4 times the amount of risk. So this trader was saying, well, what if we took this spread in red and multiplied it by 4? Well, yes, in that case, it would exactly overlap that in green, and it therefore appears to be equal. But look at what we changed. If we look at the red curve, that's the 100, 105, just this little slope area right here would be 100 deltas, and that's because we have one vertical spread that we're comparing here. If we are instead looking at the green curve, the 400, 420, between these strikes, the slope of this line is also 100. But we're also talking about in that same 5% span that we get 4 times the amount of money. So on one hand, we could say that the 100, 105 here in red is less risky. And again, that's because this slope is not as steep here as it is in green. But if we do the spread in red 4 times, then yes, it's going to exactly overlay this in green. But are they exactly equal? Well, it depends on how we want to look at it. Notice the first thing that we've changed is that we no longer have 100 deltas in here, but we now have 400 deltas. We have 4 times the amount of slope on the 100, 105 spread compared to the slope of the 400, 420. Now again, if we assume that the stock price changes are equal and have a same chances of moving these percentages, then yes, you could make an argument that they are the same. But here's where the risk comes in. If for some reason on the 100, 105 vertical spread, the one in green, that you've done 4 times, you've now got 400 deltas that are under attack, let's say, or that are at risk, compared to if you only had 100 deltas on the 400, 420. Now again, under most situations, they're going to kind of works out in the wash because both stocks are moving the same percentages. But the real risk, again, occurs if they don't move the same. If for some reason something happens to this 100, 105 vertical spread, you've now got 400 deltas in there instead of only 100. So it really shows why you have to be careful. You have to understand your strategies, and in this case, your Greeks, because if you start making changes to strategies, in this case, multiplying one spread by 4, you might be led to think that they are exactly the same, but instead you're making changes and therefore changes to your risk that you simply don't see. And if there are risks in these positions that you're simply not seeing, you're never going to have good decisions. So for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.